Well, good riddance to May, at least weather-wise, because Shakespeare's rough winds were all too evident. Let's hope that Flaming June lives up to its name, although investors will be more interested in macroeconomic news and company reports than weather forecasts. The biggest macro item of the week will, yet again, be the latest American jobs figures, and there are three sets of data to watch. The ADP survey is due on Thursday the 3rd of June, and it looks at how many jobs America created last month. For April, the data showed 742,000 new jobs added, the best number since last September. The Challenger, Gray and Christmas job losses survey is also due on Thursday the 3rd of June. The last reading here was 22,913, the lowest reading since October 1999. And finally, we get the big one on Friday the 4th of June. That's the non-farm payroll survey from the US Bureau of Labour Statistics, as the American government gives its verdict on job creation last month relative to the privately backed survey by ADP. The non-farm payrolls figure massively undershot expectations last month, as it showed the addition of 266,000 jobs. Some economists had expected over 1 million. The shortfall was attributed to a shortage of labour, which seemed a bit bizarre when the official U3 unemployment rate was 6.1% and the U6 rate was 10.4%. But the theory was that American government stimulus checks and employment support had been so generous that many workers were simply being tempted to stay at home. The result could therefore in theory be wage growth. Note how Amazon is offering $17 an hour for its new round of hires, well above minimum wage with bonuses and benefits on top. So also keep an eye on the average monthly pay number. Last month it was $30.17 an hour for an American worker, a fraction higher than the year before. If wages really start to motor, then perhaps inflation is indeed coming our way after nearly 40 years of lying pretty dormant. That said, I don't know whether the American officials have done something here with their seasonal adjustments, but this growth rate portion of the chart does look a little bit odd given the economic backdrop. Anyway, on the corporate front, June's due to get off to a fairly quiet start, at least so far as scheduled news flow is concerned. Just one FTSE 100 member is expected to release results, alongside a smattering of mid and small caps. Names which may be worthy of further note include Gooch and Housego on Tuesday the 1st of June, Wizz Air and Bloomsbury Publishing on the 2nd, and Pennon and Chemring on Thursday the 3rd. But for me, the likeliest source of a fuss in the week ahead is that solitary FTSE 100 firm B&M European Value Retail. The company is slated to release full-year results for the 12 months to the end of March on Thursday the 3rd of June. Well, the shares are up by some 60% over the past year, easily outpacing the FTSE 100 index, in recognition of how the company's helped to keep Britain, and to some degree France, fed and watered during the multiple rounds of lockdowns that we've all endured. March's trading statement gave a flavour of this. B&M European Value Retail revealed that sales, margins and profits had again come in higher than expected, with the result that earnings would beat expectations for the year to March, after the voluntary repayment of business rates relief. As a result, analysts are now looking for sales of £4.7 billion, a 24% increase on the prior year, with pre-tax profit of £469 million, up from £252 million the year before. In terms of the details, analysts will be looking at like-for-like sales growth in the final quarter. It was running at 21% year-on-year in the UK's B&M stores and was positive at value convenience chain store Heron, but slightly down at the French operations, which run under Babou and B&M France brands last time around. Attention will then switch to the outlook for the year for March 2022. Now, alongside this March's trading statement, Chief Executive Simon Arora did say the base for comparison would start to get harder, especially in the first quarter, since the April to June period last year featured a lot of panic stockpiling as the pandemic began to really hit home. Lockdowns and the pace of easing are further unknowns, so Mr. Arora and his colleagues may not want to commit to too much by way of hard forecasts just yet. However, should they do so, analysts are looking for broadly flat sales at £4.7 billion and a drop in pre-tax profit to £376 million. After that, all eyes will move to the dividend. Despite the prevailing uncertainties, B&M European Retail Value showed some confidence when it declared a 20p a share special dividend back in January, the third such payment since last spring. Overall, analysts are forecasting a total dividend for the year just ended of 57p a share, and that implies a final payment of 7.7p, up from 5.4 a year ago. For the coming year ahead, analysts are expecting a regular dividend of 16p a share. More strategically, investors will look for an update on store opening plans. B&M European Value Retail had planned 40 to 45 new openings in the UK, with 10 closures, with 20 new stores and 4 closures planned at Heron for the year that's just finished. Any comments on growth plans for the French brands will also doubtless be of interest. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.